Imagine you are watching a cricket match. The pitch suddenly becomes flat. There is absolutely no swing. The batsmen are playing it safe. The match slows down. As a fan, it's boring. But as a trader, this is exactly where the money is. Just like players adapt to pitch condition, traders adapt to market movement or the lack of it. What if I told you that there is a way to profit when the market moves less? Today we are going to deep dive into two powerful trading tools using in range bound markets. One, the short straddle. Second, the short strangle. Now these are often called as strategies, but personally I view them as a tool. Still, let's use the common term for now. Let's break it down. A short straddle is when you sell a call and a put with the same strike price and the same expiry date. So for example, if Reliance is trading at 2000, you sell 2000 call and 2000 put, both expiring on July 30th. Your view? Reliance stays near 2000 until the expiry. Let's say the 2000 call sells for 50 rupees and 2000 put sells for 50 rupees. Total premium is 100 rupees per share. That is 5,000 per lot if the lot is of 50 shares. Now let's take the scenario. What will happen? Scenario 1. Reliance stays at 2000. Both option expires worthless. You keep the full 5,000 premium which you paid. Scenario 2. Reliance moved to 2100. The call option cost you 100. Put option expires worthless. Your PNL 100 minus 100, that is 0. That is your break even. Scenario 3. Let's say if Reliance drops to 1900. The put cost you 100. The call expires worthless and your break even again is 0. Scenario 4. Big move beyond break even. If Reliance go above 2150 or below 1850, your losses exceeds the premium collected. That's why short straddle are also called as short volatility trades. You only win if the market stays calm. Now let's talk about short strangle. It's like playing with a wider cricket field. You get more space, but your reward changes too. A short strangle is equal to selling a call and a put at different strike price. So for example, if Reliance is trading at 2000 rupees, you sell 2100 rupees call for 30 and 1900 put for 30. The total premium is 60 per share. That is 3000 per lot. What is your view? Reliance will stay between 1900 and 2100. In the first scenario, if Reliance stays at 2000, both options expires worthless and you keep the total 3000 which you paid. In the second scenario, if the price rises to 2150, your call loss is 50 while your put expires worthless. Your PNL 60 minus 50 loss is equal to 10 rupees profit per share. Scenario number 3. Let's say if the price drops to 1850. Your put loss is 50, your call expires worthless. Your PNL 60 minus 50 rupees loss is equal to 10 rupees profit per share. But if Reliance goes beyond 2160 or below 1840, you start losing more than your premium. Let's compare the two. Short straddle is equal to high premium, narrower break-even range. Short strangle, lower premium, wider break-even range. So, which one should you choose? If you expect the market to barely move, go for a straddle. If you expect some movement but not too much, go for a strangle. Remember, these are not about predicting the direction, but predicting volatility lower than the market's expectation. That's the real edge. Now let's test your understanding with these 5 questions. Question number 1. What is a short straddle in option trading? A. Selling a call and a put option with different strike price. B. Selling a call and a put option with the same strike price and expiration date. C. Buying a call option and a put option with the same strike price. Or is it D. Buying a call and a put option with different strike price? The answer is B. selling a call and a put option with the same strike price and expiration date. Question number 2. When does a short straddle make a profit? A. When the stock moves significantly. B. When the stock stays within the range. C. When volatility increases. D. When the options expire in the money. The answer is when the stock stays within the range. Question number 3. Which strategy has a wider break-even range? A. Short straddle. B. Short strangle. C. Both have the same break-even range. Or is it D. Neither strategy has a break-even range? The answer is B. Short strangle. Question number 4. What is the risk of a short straddle? A. Fixed loss. B. Unlimited loss if the stock moves significantly. C. Guaranteed profit. Or D. Loss only if the stock goes up. The correct answer is option B. Unlimited loss if the stock moves significantly. Last question. Why do traders use short strangle instead of short straddle? A. To collect a higher premium. B. To have a wider break-even range. C. To take directional bets. Or is it D. To increase the leverage? The answer is B. To have a wider break-even range. Share your quiz score in the comment. I'll personally check and help you guide on your options journey. If this video helped you understand the concept of how to trade in calm markets, then share it with someone who always thinks that option can only work when the market moves big. In the next lesson, we are going to explore iron condor and iron fly and how to manage the risk with smarter way. Until then, keep learning, keep winning.